There's a question I'd like to ask to everyone, and I'm going to start with you, Byron. And the question is, where do you see the biggest risk and the biggest opportunity in 2018?
So for 2018, I think the biggest risk is geopolitical, both with tax and immigration policy, which we talked about, as well as international political stability. But I think the fundamentals of the economy and the businesses within the economy are quite strong and are likely to remain strong. Mm-hmm. And it comes down to, do regulatory or geopolitical things change the environment in which they operate to dramatically change the business characteristics. On the opportunity side, we've talked a lot about how tech is the largest sector of economic growth. Software within tech is the biggest driver, and cloud computing is the future of software. Mm-hmm. And so as a firm, we have disproportionately bet on cloud computing, and I think 2018 is very much a double down year where that trend is going to accelerate even more.
Absolutely. Thank you. Savita, what's your thinking? What's the greatest opportunity and greatest risk for 2018?
Sure. So I'll start with the risks. And I actually think there are two big risks in 2018. And one is just, how we move from a 40-year period where we got really used to a very low cost of capital, a falling cost of capital, where leverage was essentially free and cash yielded nothing. And I think that moving from that scenario to an environment where the Fed is tightening, where quantitative easing is generally shifting to quantitative tightening, I think that's going to be a little bit tricky, especially if you look at valuations of some of the most bond-like stocks in the S&P. Like utilities, I think, is too expensive given what we might see over the next 12 to 24 mm-hmm. months. So that's there are areas of the market that typically do well in a downturn, like regulated utilities, that might not do as well in a downturn if that downturn is caused by a rate spike. So I think that's what could be different this time that the market is not necessarily prepared for. Mm-hmm. I think the opportunities are manifold. The way I see this year, and we've touched on this, is that it could be a great year for sifting through the winners and the losers. So thinking about the Amazonification of, the different marketplaces, I think within the consumer discretionary sector, the internet and catalog retailers might win, and some of the bombed out retailers might remain bombed out and even, go lower. Sure. So I think that there is an opportunity right now to really look for winners and losers within sectors rather than just buying the market wholesale and betting on a beta trade.
Thank you. Dan, what do you think?
So I'll start with the risks too. On a geopolitical scale, I would agree. A risk of a geopolitical conflict is definitely concerning to me. On a market basis, I'm a little worried about the massive amount of money that's flowed into index, ETF, and quantitative-oriented strategies and sort mm-hmm. of a computer-driven flash crash. It wouldn't necessarily be something that is very long-lasting, but could be sharp and kind of scary and pull into question a lot of what's going on with. There are more ETFs now than there are stocks. Mm-hmm. And companies are actually their biggest buyers of their own stocks because of their strong cash flow. So there's been a real imbalance in supply and demand around in the market, and I worry about that effect in terms of sort of what will all that quantitatively driven money do if it sort of tends to be herd-like. Mm-hmm. But most specifically, we're definitely most optimistic about tech. Software, cloud computing, software as a service, we definitely agree those are very strong trends. Companies generally are sort of digital business transformation, adapting to the digital world. They have the money. It's been several years since the crisis. Labor is scarce. Talented tech employees are very expensive, mm-hmm. and so it's exactly the right time when companies invest in these things to improve their efficiency and also to bring themselves into the next wave of business. But we also do like a lot of the internet media and advertising trends that are happening around companies, like whether it's video gaming or e-commerce. And we think Amazon's effect is interesting because I think there's a lot of companies that will be hurt by Amazon, but a lot are going to be benefiting because they're going to be playing into the Amazon economy.
Sure, sure.
What we're most concerned about within the marketplace, I think, is actually low growth companies without a lot of pricing power. Stronger dollar effects would be pernicious for them. And then also just sort of maybe not well placed with, in particular, millennials. We haven't talked about that, but the millennial consumer. So I think a lot there of actually the consumer staple names that are beloved historic companies, but they're just not the brands or the products that the millennials are interested in. And it also extends into apparel as well.
They're not your daughter's fashion brand. Kira, what's what you're thinking? Greatest risk, greatest opportunity?
I would echo a lot of what I've heard about geopolitical risks. I think any policy errors by central bankers. So I'm not actually concerned that interest rates are going to spike or rise too quickly, but were that to happen, I think that wouldn't just be detrimental to the more defensive sectors, it would be detrimental to everybody. Well, I think it's more about, will the growth remain? Can companies maintain their capital allocation policies? Will companies continue to return cash to shareholders via dividends, share buybacks, and debt reductions from our perspective? But really, it's a risk of a geopolitical risk or policy error that would cause people to have to change their capital allocation policies. I think the opportunities, we like to say tech is the new macro. While if you're looking at dividend stocks, it's hard to find direct investments within the tech space. However, the influence on that technology has across all sectors in terms of the revenue growth, the profitability, it means margins can stay at higher levels. It means cash flows can remain higher, and there's a lot more cash to continue to be returned back to shareholders. So I think there's a real opportunity to look for the individual companies that are profitable today and will continue to be profitable going forward and can withstand any potential pressures that the market might feel.
Thank you. David, last word. Greatest risk and greatest opportunity.
Sure. Let me start with the greatest opportunity. I think tax reform would be the greatest opportunity, just from an earnings perspective. I think with the last 5 years in the market, we've basically grown earnings on a compound rate about 5% per year for the last 5 years. If you actually had tax reform in 2018, you could see earnings growth is more like 13 to 15% potentially, depending on what the corporate rate does. I think that would be a positive for the market, sort of an acceleration in earnings growth. In terms of negatives, and I know this is a sort of a one-year outlook, a 2018 outlook.
Sure.
But what I would say is, today, I don't invest on a one-year horizon. I invest on a 3 to 5 year horizon. And I think if you have a 3 to 5 year horizon, you're starting from a point where valuations are high, and I think we're not early in the cycle, we're probably later in the cycle today. That's not a good combination. So what I would tell investors today is, next 3 to 5 years, you should expect equity returns below what long-term average is, and the odds of a big drawdown, again, given where we are in the cycle and given how high valuations are, is probably greater than average. Does that mean 18 is going to be a down year? I have no idea. But I think next 3 to 4 years, I would assume that lower returns with greater risk.